Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a fantastic show for you today. We're going to be taking your questions. As always, send those to Brian Rezny at ReznyWealth.com. You know, one of the things that often comes up is from a lot of my TV and radio show listeners are about general investments that you should avoid, or investments that are sold often to the unsuspecting investor. Now, remember, I've been managing money well over 30 years. I've seen a lot of gimmick investments out there come and go. I've seen a lot of retirees and pre-retirees really lose a small fortune of their hard-earned money being sold junk investments, whether it's from their brother-in-law Bob at the big brokerage house, whether it's from the insurance person selling you some annuities, whether it's from the bank representative selling things they are forced to sell. Remember, any firm that sells products, and that includes all the brokerage houses, banks, and insurance companies, they manufacture these products. These products are not necessarily good for your portfolio, and they're often covered in layers and layers of fees that ultimately rob your portfolio. So today I want to cover some of the investments to avoid. I obviously don't have a lot of time to go in every one of these in depth, but I at least want to give you an idea. If these are in your portfolio, you should have serious concerns about the relationship you have. If you have these in your portfolio, you probably already have doubts about these investments and probably about the ability, and if your advisor is really advising at all or selling you the proverbial bag of goods. Annuities. Annuities come in variable annuity form and what's called equity index. Annuities, quite frankly, are junk. They have so many layers of fees that ultimately rob your portfolio returns. It's sickening. Why do so many so-called advisors sell annuities? It's simple. They make huge, lavish commissions at the financial detriment of you, the client. Your financial security is taken away, in our opinion, when you're sold one of these crummy products. People buy annuities for a lot of fake reasons or false reasons that are often told to you by the so-called advisor. Things like income for life or inflation protection or no cost. And again, a lot of these things are factually not true. We often have people will call my TV and radio show after they've bought an annuity, have held it 3 or 4 years, and realize after looking at the returns that what they were told they were going to get is not factually happening. Then they realize they need a second opinion. They'll call my firm. We basically give them the details on how they were really bamboozled or taken advantage of. Then they ask, how can we get out? The bad news is, once you buy an annuity, a lot of these annuity products have surrender penalties that can last 10, 15, or more years to get all of your money out without a severe surrender penalty. That is not good. You as an investor should never be subject to high cost structure, and you should never ever buy any investment, there's no reason to, buy any investment that has a back end surrender penalty or that is not liquid. You don't need to do it. Don't let a salesman at a free steak dinner seminar pitch you an annuity, give you all kinds of promises that are not going to materialize, and again, now you have to get out. It costs you a fortune of your money, you'll lose it, and then you got to start over 3 or 4 or 5 years later. And by the way, annuities, the taxation on them once you take the money out is crazy. You pay more taxes, you pay more fees, you insanely lock your money up for what? To make less money on your money? That makes 0 sense at all. By the way, if you go to our website, ReznyWealth.com, at the bottom of the homepage, we have a free report, Why Annuities Are Dangerous to Your Wealth and Retirement. Non-traded real estate investment trusts are another investment to avoid. What's a non-traded real estate investment trust, or REIT? These are packaged pools of money. These investments are often sold by so-called advisors, again, a lot of them through the brokerage houses. These are not liquid investments. You put your money in and you cannot decide when you're going to get out. It's when that REIT or real estate investment trust decides to liquidate. You could have your money locked up for 10, 15, 20 years with no access to your capital. And if the investments in a non-traded REIT go south, again, you can't sell and get out before you lose a significant portion of your money. Non-traded REITs are manufactured by a lot of firms, and they're sold through so-called advisors who are not fiduciaries, who again are only looking to line their pocket the most. I receive dozens of phone calls and questions every month on my TV and radio shows from retirees and pre-retirees just like you who were sold these crummy non-traded real estate trusts. The income drops, the value drops, and they can't get out, and they want to know, can we help them? The sad reality is, the best advice I can give you, again, never buy anything that is not liquid. Annuities are bad, and so are non-traded REITs. Alternative investments, again, sold by these so-called advisors. Things like hedge funds or commodity funds. Again, more fees, more junk, and more illiquidity. These are things you don't want to be sold. But what happens is, again, that so-called advisor, that brokerage house that's not a fee-only fiduciary, or that bank rep or insurance person, again, that are not fee-only fiduciary money managers, like selling this stuff. Why is that? Lavish commissions that pay their mortgages and steal away from yours. Never ever buy any hedge fund, commodity-based fund, alternative investment structured fund. You don't need to. Don't insanely lock your money up, and don't get killed and clobbered by excessive fees and cost structure that only rob your returns and again line that Wall Street pocket, that so-called advisor. Structured products. Again, these are manufactured for the brokerage houses, by the brokerage houses, and then again sold to you, the unsuspecting investor. These things are complex, they have lockup periods, they have high cost structure, and again, who's the one really benefiting from a structured product? The so-called advisor, the broker, the brokerage firm. Buyer beware and stay away. Another one that's been pretty popular the last 5 or 10 years are options. Options are basically, again, complex products, high cost structure, and most people do not have the ability or the time to properly trade options. It's a full-time job. But options, again, are manufactured by various brokerage houses or institutions in order to generate more fees and commissions on an ongoing, we call considered churning against you, the client. We don't believe in options, and we don't think you, the investor, should either. As a fee-only fiduciary, remember, Rezny Wealth Management legally works for their client 100% of the time. The investments we talked about earlier, we don't utilize. Why is that? Because they're not what is best for you, the client, and if it's not best for the client, it's not going to show up in our client portfolios. The cost structures alone, surrender penalties, again, rob your overall returns. Hey, if you want to learn from others' mistakes, I've got some upcoming workshops you as a pre-retiree and retiree must or should attend if you want to learn more. The disturbing facts most investors are shocked to learn. Learn from others' investment and retirement mistakes so your investments and retirement portfolio is not devastated. Some of the things I talked about earlier that you should avoid, I'll talk about in more detail at my workshops. These are things you should learn. You need to learn how to protect your money from these outright salespeople that don't legally work for you. Remember, there's not one bank, not one insurance company, not one brokerage firm that is a fee-only fiduciary money manager. They sell product, unfortunately, complex, hidden cost, rob your return. Go to ReznyWealth.com for dates and to sign up for any of our upcoming workshops, or if you're realizing the advice you're currently receiving is not advice at all, call my firm during the week for a consultation to discuss our services, or go to, again, ReznyWealth.com, click on that consultation tab. We would love to help you get back on track and avoid mismanagement of your assets, conflicts, and that sales advice that you're getting from that so-called advisor. I'm going to take a quick break. I'll be right back with questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. And we're back. I hope you're enjoying today's program. And again, if you want to send me an email question, send that to Brian Rezny at ReznyWealth.com. And as always, visit our website, ReznyWealth.com, for times availability of my TV shows and my live radio shows on the weekend. Our shows are developed for you, the investor. We want to protect you from that bad advice from those so-called advisors. We want to protect you from being sold investments you shouldn't have been sold in the first place. If you want to learn more, keep listening to our programs and send us an email question. We'd love to hear from you. Paul in Ohio. What is the appropriate amount of cash holdings? You know, Paul, that's a great question. Generally speaking, the only reason you hold extra cash at home is a small emergency reserve. $10,000, $20,000 for most people is all you need. Because if your portfolio is liquid, you can always access it if you need more. The only reason you would leave more than maybe 10 or 20,000 liquid reserve, kind of for that emergency reserve, is if you have a major purchase coming up that you have to have the money safe. As an example, in 12 months you're going to buy a new car and you need $30,000 to pay for the car. Or you're buying a new house in 2 years and you need that down payment of $40,000. Any money you need within the next 3 years or less that has to be safe, you want to keep that in a more of a safe cash holding type investment so you don't lose out in case we have some short-term turbulence in the investment markets. Cliff in Florida. As inflation is on the move, wages are increasing, and are you still bullish on small cap stocks? How about dividend stocks? Thanks. Love the show. Cliff, thanks for the nice comments. We do still like small cap. And again, as a reinflation trade in the overall economy, I think small caps have an opportunity. Wages are going up, and ultimately we are having some transitory inflation, but some of it won't be transitory, folks. We're going to have some permanent inflation. Am I overly concerned about inflation? No. There are going to be areas in pockets of inflation, but some of it will ease as the supply chains start to come back, meaning supply and demand. There's a lot of demand. Some supply chains are not there with the supply. That forces up prices. We're starting to get back on the manufacturing side, and generally speaking, the U.S. economy is starting to move back in a good way. That will help ease some of these inflation fears. But again, we're going to see some of these increases that are not going to go away in the next 6 to 12 months, and they'll be here to stay. So you need to invest your money accordingly, because if you're making low rates of return and inflation's a tad higher, you're obviously losing spending power, and that could be detrimental to your overall portfolio and retirement. Bob in Naples, Florida. I see the marijuana industry eventually exploding. Do you think it is a solid investment or a speculation investment? Bob, I think marijuana stocks in general are really a speculation type trade. Very risky. While I think they're going to have more legalization of marijuana over time, it's not an area that I would really dabble in for any significant portion of a portfolio. I believe you're speculating. One of the things that I've learned managing money over 30 years, Bob, is this. If you speculate, if you buy high risk investments, it doesn't really make you any more money. You tend to get more volatility and make lesser returns. I believe in this steady Eddie wins the race. I believe you buy quality companies or quality industries or sectors that are fairly valued, and they have long-term opportunity in the portfolio. And you make adjustments in that portfolio as dynamics change. But again, I think marijuana is a speculation trade, and I would ultimately tell you to tread carefully, or you could lose a lot of your money. Richard in Fort Myers, Florida. What are your thoughts of making use of option trading as part of an investment strategy? Richard, I would suggest this. I don't think any of our TV or radio show listeners should get involved in options. Options are complex. They have expense to them, and ultimately if people think they're going to make more money or maybe reduce risk in a portfolio, and for most people that I've seen managing money over 30 years, when they get involved in options, it's again through the brokerage house from the so-called advisor, and what ultimately happens is that client doesn't really make any more money. All it is they're basically making the brokerage house more money and they're giving up ultimate return. I would tell you to stay away from options. I think you build a quality portfolio, you monitor that portfolio, constant research, and fine-tuning adjustments over time, as all portfolios need to be adjusted. By the way, Richard, if you want to learn more about real investing and you want to learn how to learn from others' mistakes so you don't make those, I've got some upcoming workshops. The disturbing facts most investors are shocked to learn. Learn from others' investment and retirement mistakes so your investment portfolio and retirement is not devastated. I've got some upcoming workshops. Go to the ReznyWealth.com website, click on that workshop tab for times, availability, and my full talking points. One thing that I'm very proud of as the president of Rezny Wealth Management is educating you, the investor, so you don't make bad decisions around your portfolio or you're not taken advantage of by one of these big brokerage house or Wall Street firms, or the guy doing the free stake seminars hawking annuities. These are big mistakes that investors make. We'll teach you about those, and we'll teach you about other things you ultimately need to avoid as an investor. Larry in Florida. Brian, how much upside do you think is left in the market? Larry, that's a great question. If you said to me, Brian, what's going to happen in the next 1 to 3 months? Honestly, I have no idea. The economy is doing well, but is the market going to go down 3% in the next month or two? Really, to be brutally honest, I don't care. I'm looking at the next 3 to 5 years. I know I'm going to have some turbulence in the middle, but we're looking for quality investments or sectors to put in our client portfolios that we believe have upside potential, that are also fairly valued, but are growing revenues and sales. These are areas of how you want to invest. You can't really control short-term volatility, and it's always going to be there in all investments, not just the market. But I think if you're looking at the next 3 to 5 years, I think the U.S. marketplace in general is one of the best places to be. I would continue to avoid Europe, and for most of you investors, I would continue to avoid the emerging market economies. There's a lot of stuff going on with China on regulation and crackdown, and I think a lot of these emerging market funds are risky for the upside they hold. And I've talked for years about avoiding Europe. I think a lot of these international investments are lousy, have risk, have little upside, so you're taking more risk for less upside. Why not invest in one of the strongest economies in the world, or the strongest? You can diversify properly in the U.S. marketplace without getting involved in maybe some of these speculation type trades. That's my recommendation. Dean in Naples, Florida. Our portfolio is $850K. in stocks and mutual funds. My question is, we seem to have as much volatility as the market, but our returns are way less, like 3% less based upon the S&P. From what I can tell, our advisor says it's normal for a dividend portfolio. Your opinion? What I think is your advisor is probably actually a salesperson working for a brokerage firm. I'm guessing you've got a fee-based account or a commission account, and ultimately dividend stocks tend to be less volatile from time to time, and other times they can be more volatile. But if your portfolio is invested in the equity stock market and you're making substantially less, 3% less a year is about a 30% decrease in the average return of the S&P 500 long term. That's a big difference. We're not talking a little bit, we're talking a third, losing a third of the return you should have made given the risk that you're taking. But you said you have more volatility. So what it sounds to me like, you have a portfolio that probably is concentrated in 30 or 40 individual stocks, which will give you more volatility. From our findings and me managing money for over 30 years, what I think's happening ultimately is you have somebody who's buying investments they probably aren't doing the research on. It's adding volatility and risk, and you're not getting paid for it. You may want to consider calling my firm for a consultation if you want to discuss our services and how we're different from that Wall Street firm or that bank that you're probably utilizing right now. Folks, I've got to take a quick break. I'll be right back with more questions. Make sure you do go to ReznyWealth.com, check out our website, check out our workshop tab, and check out our consultation tab. And as always, you can download any of our groundbreaking reports and learn about investing and hopefully how to better your retirement because of it. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not family fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 Investment Risks You Must Avoid Now. And we're back. I hope you're enjoying today's program. And as always, send your questions to Brian Rezny at ReznyWealth.com. And do visit our website, ReznyWealth.com, for times availability of our TV radio shows. You can also set up for a consultation via our website and learn more about our firm and proper investing structure over time. Ken in Fort Myers, Florida. We have 2 Lincoln Choice Plus annuities. I really don't understand the expenses, and the annuities have performed poorly the last 5 years. We are invested $250K, now worth $257. We have procrastinated coming to see you for a second opinion. Help, can I get out? You have a great question. Let me explain what happens. I don't know the specific options you have on these annuities, so I'd have to really look at the prospectus itself. But let me talk about variable annuities in general. And they're all very similar on a chassis build. Most variable annuities that my firm has reviewed over 30 years, and I've reviewed thousands of annuities, mind you, the average variable annuity I find has an expense ratio, annual expense ratio, of between 3.5% and 4.5% a year. That's ludicrous. What I often find is the investment options in these variable annuities are limited and they're poor performing often. So you've got poor performing investments or limited options, you've got high expenses. What does that lead to? Probably poor performance. Yes, you can get out of an annuity. You may have a surrender penalty. You may not. There are ways to bleed that money out of there at a lesser surrender penalty that we may be able to discuss and point you in the right direction. You don't have to live with those crummy annuities, but generally speaking, people are sold annuities without understanding the full complexity and the cost structure, and that cost, folks, will rob your retirement and portfolio value over short periods of time and long periods of time. Again, call our office. We'd love to talk to you about managing your money and about our services and how you could benefit from the Rezny Wealth Management difference. By the way, we do have an upcoming workshop or a couple workshops coming up. Go to our website, The Disturbing Facts Most Investors Are Shocked to Learn. Learn from others' investment and retirement mistakes so your investment portfolio and retirement is not devastated. I'm going to talk about the economy. I'll be talking about things you should be doing and things you should not be doing with your portfolio. You know, this year and next year, in my opinion, are going to be pretty crucial. There's going to be changes you should be making to your portfolio as this economy continues on the correct path, in our opinion. And there's areas you should not be invested in, and I'll be discussing a lot of that at our upcoming workshops. And our workshops, by the way, are perfect for people who at all are having doubts about their portfolio, who they are currently hiring. Maybe it's you're self-managing and you're realizing you're not maybe doing the best job. You should also attend one of our workshops. Go to ReznyWealth.com for times, availability, and to sign up. Kim in Miami, Florida. What do you think of Apple? I actually like Apple Computer. We actually own shares of Apple Computer in our managed accounts. I think Apple's a great company. I think the growth potential that Apple has seen the last decade is not going to be as robust because of the size of the company itself at this point, that critical mass. But we do like the company. I think it's fairly valued. And I think ultimately as they continue to really roll out additional services, especially on a fee structure side, I think they have an opportunity to increase the earnings, which could add to the bottom line of that stock. Dale in Bonita Springs, Florida. What do you think of preferred stocks for dividend income? You know, actually, I like preferred stocks, but I wouldn't overload the boat. Preferred stocks are like common stocks. It's a hybrid. They act more like long-term bonds. So if you buy a common stock, you're really looking probably for growth and income. If you buy a preferred, you're looking for more income and less growth, really. And if interest rates go up, preferreds can go down in value, kind of like long-dated bonds. So if you're looking to add a piece or a slice of preferreds, I would say 3 to 5% in a portfolio would probably be max. Don't overload the boat with preferreds. I think what you really want to do in a portfolio, especially in low interest rates today, is look at a total return strategy. More growth, less income. You can always sell some of that growth off each year or when needed to provide a higher income stream, combating inflation. And I think really too many investors are oversaturated in bonds, which will have a detrimental impact on your portfolio. Fred in Naples, Florida. My wife and I are both 67 and recently retired. Our advisor wants us to put $700K into an equity index annuity for lifetime income. How can a retiree protect themselves from inflation? Will this help? Fred, don't do it. You've got yourself a salesman working under suitability. Equity index annuities are garbage. Okay, and first off, if you take an equity index annuity and you convert it to an income for life, there's no inflation protection. You'll get the same money today in 5 and 10 years. It doesn't ever go up. So how could this person tell you you have inflation protection? You'll have none. In fact, in 5 years, your income will actually decrease by 15% at a 3% inflation factor. And your investment won't go up because you're bleeding it out of this annuity. Annuities are sold products. If you are sold an equity index annuity and you're promised some high returns, it's not going to happen, folks. Equity index annuities in general are designed to provide maybe 1 to 1.5% annual returns. That's it. If you think you're going to make more than that, you're not going to. And if that salesperson, that so-called advisor is telling you different, they're lying to you. Watch out for these people. What they want to ultimately do is sell you an expensive annuity that insanely locks your money for 10 or 15 years. And at 3 or 4 years into this, Fred, you're going to realize you made a mistake. And the only way to get out is with a huge surrender penalty to get all your money out. That's a mistake you do not want to make. Go to ReznyWealth.com. Go to the bottom of our homepage, by the way, Fred. You can download our groundbreaking report, Why Annuities Are Dangerous to Your Wealth and Retirement. I also suggest every one of our listeners click on that workshop tab. I've got 2 workshops coming up. Disturbing facts most investors are shocked to learn. Learn from others' investment mistakes so you can benefit and not devastate your portfolio. Folks, I'm out of time. Go to ReznyWealth.com. And as I've always talked before, if you're looking for real advice, if you're tired of bad advice, tired of conflicts that undermine your financial security from that so-called advisor, sad fact, most advisors are really salespeople selling products they are required to sell that are inferior, expensive, and they're not the best for you. Real money management is what Rezny Wealth Management provides. Fee-only, fiduciary money management. Exactly what you desire. Call our office during the week to schedule a consultation. We can talk about your portfolio. We can talk about how we can manage your portfolio to meet your goals and objectives in a way that is beneficial for you and your family. And as always, visit ReznyWealth.com, and I'll see you next week.